Go ahead.
Good morning, Mr. Barry Schwartz. Thank you very much for doing this. I really appreciate your time.
Trevor, thank you for having me and always love to talk investing. So you caught me at a good time. The markets are up this morning and that makes me feel good. The stock market is like a mood enhancing drug. When it goes up, you feel great. When it goes down, you feel great because you get to buy more. So it's like you can never lose.
For the listener, you are the Chief Investment Officer at Baskin Wealth. Maybe just to explain what the company is, what is Baskin Wealth?
Yeah, so Baskin Wealth manages portfolios for high net worth clients across Canada, and we have about 1,200 families that we work with, and it's all customized portfolio management. It's really more of a boutique style of investing. We buy individual stocks and securities for our clients, and really plain vanilla. We stick to high quality companies as well as bonds. Um, and we like to know our clients, have a great relationship with them, also do financial planning, all types of wealth management. And it's the old school style of investing where we are actually researching the companies. I'm the guy who's involved in researching the companies along with our head of research, Ernest Wong. And we have a style and an approach that we think works over the long term, and that's really how we invest. We're business owners. We follow the Warren Buffett approach of owning businesses. And no question, as a part owner of Baskin Wealth, I think I've become a better investor by owning a business. And so, I think our clients really like the unique approach that we take to getting to know them and their goals, their objectives, and then building a portfolio that works for them, given our process.
How did you get into investing?
Well, that's a great question. I would like to say that I wish I picked up a book at age 5 on Warren Buffett and got interested in it then, but um, I tried a lot of different things in university, and I worked for a mutual fund company after getting a business degree, and I kind of got the bug then. So I came out of university in 1997, and that was the beginning of the dot-com boom. Of course, everybody remembers the famous bust, but the beginning of the boom was a lot of fun. And my job at the mutual fund company was a lot of data entry and processing, and it was quite boring. And so I spent a lot of time looking at the stock market and doing my own trading. Good thing I didn't last there very long, but that's how I got interested in it. And I got lucky, Trevor. I turned a few $1,000s into $100,000 on my own by buying silly stuff. And nothing ever changes in the market. But I remember buying a stock at lunchtime, investing maybe a couple $1,000s, and then after lunch selling it for $6,000. And I'm like, I'm a genius. And I remember saying to my girlfriend, which is my wife now, that I'm going to quit this terrible data entry job because I hate my boss and I hate the job, and I'm so good at investing that I'm going to make us a fortune. Well, the good thing is she told me I'm an idiot, and luckily, when I quit my job at the mutual fund company, I went back to school to get an MBA. That was really the end of the dot-com boom, and I needed to pay for MBA. I was going to get married. I wanted some cash to put on a down payment on a house, and I got out by the skin of my teeth. So I turned a few $1,000s into $100,000, not because I had any skill whatsoever. It's just I rode the wave and I got out at the right time. Had I stayed in a month later, Trevor, I would have lost all that money. So, just another lucky investor. And of course, we've seen so many booms and busts. You can talk about that over my career. Nothing ever changes, but that's a little history of how I got interested in investing. And I went back to school, got an MBA, and I saw a job posting for Baskin Financial Services. That's the name of the company. Although we go by Baskin Wealth Management, that's our marketing name. And my partner David Baskin, he was looking to hire an analyst, and I was looking for a job, and I've been there now. I've been here now 23 years.
Did you have a investing style, kind of maybe along the lines of a Walter Schloss, Ben Graham value method, or a Phil Fisher growth style, or how did you think of it that way? Did you have a preference for investing,
When I was younger, I
or anytime?
well, certainly when I was younger, I knew nothing. And I learned investing by not by getting an MBA and not by taking my CFA, not by taking the CIM. I learned it by working in the markets with clients and David Baskin, and that was the experience. And so for those learning how to invest, it all involves experience in the markets and honing and finding your investment style. And so over the years, over my 23 years at Baskin, our investment style is always constantly evolving and changing and trying to improve. And I think about 10 or 11 years ago, we finally caught on to the fact that why are we investing in commodity names? Why are we investing in cheap companies that are still lousy? Why are we buying only dividend paying stocks? Why don't we just buy the best of the best? They seem to, those stocks seem to outperform over the long term, and there's less trading involved in those names. You don't have to catch the cycles as much. And so about 10 or 11 years ago, some of the world's best businesses, we can talk about later, were trading at very reasonable valuations, the Apples and the Microsofts. And we just said, let's focus our energy more on there. I mean, we're Canadian based. All of our clients are pretty much in Canada, but Canada's a small universe in the overall stock market, overall world. And whether you like the US or you don't like the US, the one thing that I think is fact is they have some of the greatest companies in the world. And so that's another thing we discovered. We got over the hump of being, I guess we were a little bit scared or intimidated by investing money outside Canada. What about the currency risk? What about the taxes? But I think that was really like trying to pick up nickels instead of in front of a steamroller. And so our style has evolved over time. It will continue to evolve. But for now, it's really it's really a morphing of, as you mentioned, Fisher for sure, Buffett, a little bit of I really have a lot of respect for an investor in the US called Ron Barron. I like Bill Miller. You got to learn from the greats. Like this is not something that you're going to be a genius at right away, but you have to find the investment style and approach that works for you and your temperament. And it also has to be a style that can get you clients as well, right? So it has to work hand in hand. So for us, it's all about quality, owning either the best businesses we can find in the countries that we're comfortable owning them in, or companies that may not have the best operating type businesses, but run by management teams that know how to create enormous value. And so that's the style. I don't really know how to pigeonhole it, and we'll continue to evolve it and improve it from there.
A lot of the best investors would explain their investment strategy as a craft where they can't really put it down in a precise formula on a spreadsheet or in a textbook. Do you view investing as a craft?
I do. I love the way you put it because I see it like a work of art, and I cry a tear every time when someone wants to sell my work of art or someone's not happy with it. Um, I remember, and we don't get along with every client, and clearly we're not the right fit for everybody. Some want to see more activity, some want, like, why aren't you owning that winner of the day? Why aren't we into the marijuana stocks? Why aren't we into the junior oil stocks? Right? So, but when someone wants to sell some of the greatest businesses in the world because the stock hasn't performed in a short period of time, it hurts me deep inside, Trevor. You have no idea, because I think what we're building, what we're creating in a portfolio is really things that can be hung on a wall. And if you just leave them alone, they're going to just appreciate for you. And so that's really the competitive advantage of the long-term investor. That's what Warren Buffett figured out, is all you have to do is sit on your tush and watch the grass grow.
What's the saying? Don't just stand there, do something, or
Yeah,
don't do something, just stand there.
exactly. Or yeah, or whatever Charlie Munger says, like if you just sit alone in a room and think instead of trying to do something, you'd be such a better investor. I spoke with a client the other day, Trevor, and he's like, we had a tough year in 21, 22, Barry, and I wish you would have taken more activity. I'm like, but then we're having a great year in 23 by not taking any activity in 22. And as everybody says, the seeds that you plant today, if you pick the right ones, are going to grow and mature. I get the frustration people have when they buy a stock and it does nothing for a year or 2 or 3 years. But that's the stock price. Let's ignore the stock price. Let's focus as you're a business owner. If the business is improving or you can see a clear path, you're an idiot to sell. You're an idiot to do anything. And so I really, I mean, I really want to focus on not doing stupid things, slowing down, taking a breath, not trading, not reacting. It would have been so easy in 2022 with the stocks that we owned, which were not the best names. A lot of quality was the worst performer last year. It would have been so easy to sell them and buy oil and gas, or buy dividend payers, or the banks, or the utilities, and then that would have been the worst decision for our clients. And I remember people telling me, well, Barry, you have too much in big tech. You have too much in whatever's not working. I'm concerned. Of course, what's the best performer in 2023? And so, there's a guy on Twitter, I think his name is Charlie Biello, and he posts lots of great charts. Like the best performer over the last 10 plus years has been US high quality. NASDAQ has killed it. So, like, why do you have to set the bar so high? Why do you have to make life so difficult for yourself? There's no guarantees that's going to work going forward, but that's what we've learned over time is quality tends to be the best performers.
As an active investor, your job is to pick undervalued stocks and buy them with the hopes of appreciation to earn money for your clients. On the other hand, you don't want to be buying and selling too often. The idea is to pick your winners and sit on them. Where are you seeing value nowadays? Are you buying in a particular sector? Where are you looking?
Well, that's a great question. So we build a portfolio of around 30 stocks, and we do the old-fashioned research. This is not something like, oh my God, the stock is down 10%. Let's buy it. We want to understand the company. We want to understand the drivers of future growth. So when you're buying a stock, you're not buying the past, you're buying the future. You're not looking out the rearview mirror, you're looking out the windshield. And what you want to do is, am I paying a reasonable price for the future growth, especially if you're buying quality, because they'll never look optically cheap. So where am I seeing value? Obviously, the first thing you want to do is if you're looking for opportunities, is you want to buy companies that may have underperformed in the short term for whatever reason, whether the market is concerned about a disruption risk, whether the investors are concerned about a valuation, or there's been a rotation. So if you would have asked me last year, I would have said the best buys in the world are the quality names. They've recovered a lot. And if you would have asked me a couple months ago, I would have said Google and Amazon were like incredible values because they've been beaten up. So, to really be honest with you, there's not as much value in the technology names as there was a few months ago, just because they've recovered so dramatically. All those FANG names, Facebook, Apple, Netflix, Google, they're all up 40% plus this year. So the value's they're not super expensive, but they're not dirt cheap anymore. Probably the more value is some of the names that I didn't want to own in 2022, which are the Canadian banks, the oil and gas names, maybe the telcos, maybe some of the pipelines. Those are areas that have been beaten up more. But then, of course, they're facing a lot more headwinds than they've ever faced. So to me, the tailwinds are more clear with quality names. That's why I love owning them. But there's more value in areas that have been beaten up if you're looking for value, right? The Canadian banks, for example, trading at 10 times earnings. Their price to book has dropped dramatically. There's lots of worries about recession, that Canadian housing market, the oil and gas market. I know that's one of your favorites, has pulled back a lot, but the prices have pulled back. There could be opportunities in a name like Nutrien, for example, potash, and prices have pulled back a lot. But of course, then you have to live with the volatility of those commodity names. So if I was interested in them, it wouldn't be a very big part of our portfolio.
If I'm correct, you have added some energy names to your portfolio lately, one being CNQ. What led you to that decision, and what do you see in a company like CNQ?
Yeah, so we I went on Twitter and BNN a number of years ago, and I said that we're never going to buy oil and gas and commodity names again. And that turned out to be a pretty good call. And I think I made that call in 2014 or 2015. And that was a good call and a right place to be, because oil and gas was not, it's always been boom bust and very hard to make money. Um, Now, many investors and people who follow me on Twitter and BNN probably won't remember this, but Baskin Wealth, we owned significant positions years ago, pre the financial crisis, in commodity names. We owned potash, we owned all these metal and mining companies that got taken over, like Inco and Alcan, Falconbridge, and Inmet Mining. We owned a number. We were original investors in Berkeley Petroleum, which is Mike Rose's first company. We made money there. We owned a lot of these oil and gas trusts. That was a different story. And the thesis from 2002 to 2007, when we owned them, uh, was that China was eating up all the resources like crazy, and the world was growing quickly. Remember that acronym, the BRICS: Brazil, Russia, India, and China. I mean, they were
Mhm,
booming. So
mhm,
owning commodities made a lot of sense. Then the financial crisis ended that. And then we kind of pared back as those companies got taken over, and we did quite well on them. We didn't really reinvest. The last metal and mining company we owned was Inmet Mining, that got acquired by I think it's FNM Mining. I can't remember the ticker symbol now. It's one of the smaller metal mining companies in Canada. We also own Tech Resources. But so long story short, why did we come back to CNQ? So in 2011, we owned CNQ and Suncor. Those were the only two oil and gas stocks. And I remember reading about, everybody talked about the wall of cash flow that was going to come from Canadian natural resources. There was going to be this, uh, at some point in time, they'd be done the gigantic capex of building out the oil sands, and then the rest was going to be gravy. It never materialized, Trevor, until about 2 years ago. And unfortunately, we missed that recovery in oil and gas in late 20 and 2021.
mhm.
But the dynamics changed. And what got us interested in buying Canadian natural resources is really, we think the major capex is over. The company is getting that oil out of the ground at very low prices. And as long as oil stays above 50, $60,
Mhm,
there's going to be that gigantic wall of free cash flow for decades. And
mhm.
so when we owned CNQ, there weren't share buybacks like there are today. And there wasn't the high dividend yield like it is today. And so things changed. And so that's what got us attracted to the stock. We started buying it in the mid $60 range when it pulled back, I guess, in mid 22. And that attracted us to it. We also love the management team. Remember I said that we like to own companies that have strong management team that know how to create value. Arguably, Murray Edwards and the CNQ team are one of the best in the
Mhm.
world, maybe the best. And so that's what drew us back to investing in oil and gas. The dynamics of all these pipelines that and infrastructure that's now almost built near completion in Canada, has changed the dynamics of getting that Canadian oil and gas now to many different markets. So that's number one purchase, and we also started recently purchasing shares of Tourmaline Oil as well.
Speaking of high quality management, Tourmaline would be up there with Mike Rose, perhaps one of the best, or maybe
Yeah,
Headwater Exploration with Neil Rizal, Pine Cliff Energy with Phil Hodge. Do you look elsewhere in the industry beyond Tourmaline or CNQ, or is
we're
it
not
pretty?
small or mid cap guys. We love to own the best of the best, and so I mean, those could be great companies. I've never spent any time looking at them, but what attracts us to Tourmaline is the same type of dynamics as Canadian. So I have clients in Alberta, and they tell me that then they do work for CNQ, they do work for Mike Rose, and they say they're the cheapest guys. They don't pay enough money to their contractors, and they're telling me that's a risk because that hurts their bottom line, and I'm smiling. because that's what I love to hear. Because we all know oil and gas is a boom bust business, and so what if they'll always be a job and work at for contractors to do work at CNQ and Tourmaline because they've got so much infrastructure spending to go for years and years and years, and the small guys, they boom and bust. So we love the cheap the cheap management teams of those companies. We love the insider ownership. I love that Mike Rose, every time the price of Tourmaline hits $55 or 56, he's buying more. He doesn't need to buy any more stock. He's worth a lot of money. I don't know if he's a billionaire, but he's worth a lot of money, and yet he still comes to work every day and looks to add value. And so, I'm not the right guy to talk about specifics because I'm more a generalist. But what I'm looking for is two or three things in a company that get me really excited about owning it for the long term. And so I think the changing dynamics of the oil and gas, the fact that these two companies have some of the best balance sheets, that they've clearly articulated that they're going to turn a lot of money to shareholders. So, I mean, I know Canadians love our bank stocks and utilities, but hey, I see CNQ and Tourmaline as like the blue chips of the blue chips if you're looking for shareholder returns.
Bubbles. Some people would argue we're in an AI bubble right now with certain stocks trading at 30 times revenue or whatever
Yeah.
metric you want to measure. Do you view it as a bubble right now? And how do you profit from that, if so?
Well, I mean, AI is just getting started, so it's impossible to know, and this is how markets work, right? Bubbles always happen before the profits start to show up. Isn't I mean, Nvidia, totally missed that stock. I tend to stay away from more cyclical type businesses, and so that has kept us away from the semiconductor industry for good or for better or for worse. Obviously, for worse with Nvidia, but I don't know. I don't know if it's in a bubble. I mean, it's easy to say now because you can see the valuations. But on the other hand, Nvidia is very profitable. This is not buying pets.com in 1998. This is buying a company that's firmly established and huge demand for its products. And we all know that the AI use for data is just going to require more chips, more infrastructure. I don't know if NVIDIA is going to be the main winner. I don't know if ARM is going to be the main winner, ASML. I mean, there's so many different ways to play AI. Um, but yeah, I'm sure there's always stocks in a bubble, but I don't buy them. So I tend not to care. I spend all the time thinking about our companies and the companies that we own. So we own a lot of those big tech names more on the software side, like Adobe and Apple and Microsoft and Google and Amazon and whatever. I mean, I own all those names, and I think they're going to be the winners in that AI race because they have the global platform distribution, right? You and I may come up with a better AI solution than what Microsoft has, but who cares? Because if you don't have the distribution and the established customer base, you're not going to win. And so that's how we feel is the best way to play it. But it could be in a bubble, impossible to know. I mean, there's lots of companies that I would never touch, but I don't spend any time thinking about them because I don't care. I only care about our companies that our clients own and that I own personally.
Some people have been calling for a recession. We're due for a hard landing and that things are going to get bad. Yet I have yet to see a recession occur. The S&P
Mm-hmm.
is up 10% over the last year. Housing market strong across Canada.
Yeah.
There's no recession yet. So in your opinion, where's the recession? Is there a recession? Are we headed there or maybe not?
Okay, well, we kind of had a recession in 2020. We haven't had a recession since then, and that was a weird recession. And that made sense because you shut down the world and then you opened it back up with zero interest rates and free money for everybody. Um, we are in a recession in a lot of certain sectors, Trevor. I mean, that's undeniable, right? Whether it's some retailers or shipping or manufacturing. Many companies have too much inventory. Consumers don't need another TV. They don't need to redo their backyards or their patios anymore. They don't need any outdoor furniture. So, I mean, you're seeing it from the commentary from companies like Costco or Dollar General about where people are spending money on and not spending money on. But then again, there's no recession in experiences, right? Good luck trying to book a vacation now to Europe, or getting a hotel room in Vegas at a reasonable price. It's not going to happen because the pent up demand is huge. And then, of course, China's now opening. So there's Asian travelers that haven't been able to travel for years, and they got lots of money that they want to travel as well. So, I mean, it's so interesting what's going on. We're more in a recession for things, and we're in a boom for experiences. So and it's all, as you know, screwed up because of COVID and the shutdowns and then the reopening and the supply chain. And that's going to take a number of years to work through. In the meantime, you know that we have like extremely strong employment,
Exactly.
right? And however, I mean, you can't push on that string too much. I mean, it can't go much lower. So, um, I think we're already in a recession, and like I said, in a lot of areas, and so people are confusing that with a global recession or like across the board. But I don't know. It's macro stuff is impossible to figure out. It's clear that are going to have some worries in Canada in a couple of years as people's variable rate mortgages go up, as their fixed rate mortgages that they may have got at two. Like I spoke to a client yesterday, and that client just bought a house in 2021, and they got a variable rate mortgage at 1.8%, and they're laughing. And then the client's like, I need to do a reno on my house. I'm like, cool. He's like, should I borrow the money against my line of credit because I'm getting 1.8%? And I had to explain to the client, you're getting 1.8% on your mortgage, but your line of credit is the prime rate, and prime rate in Canada is 6.7%. And it's going to cost you 6.7% plus
Mhm.
to for interest on that reno. He's like, ooh,
Mhm.
I didn't know that. So people are going to have a wake up call when their 2% mortgages come due and they may have to renew at 4 or 5%. And that's going to put pressure on consumer spending, not necessarily for the extremely rich or those who have don't have mortgages, but for those who are already on the margin. That's going to make an impact whether they take a vacation or whether they go out to eat at a fancy restaurant or buy, you know, some luxury bag that, right? It's going to be a problem. Um, of course, that's 2 years from now, and we just don't know what interest rates in the economy will look like. But I would tell anybody who has a mortgage or has things coming due in the next few years is, if you can right now, double up on those mortgage payments. If you can right now, start saving, and because the world may not look so rosy for you in a couple of years. And of course, if that happens, the job market could be I mean, you could see a cascading effect. So, to short answer to your question about recession, I don't know if it's going to happen. And to be honest with you, the best time to invest is when everybody is worried about a recession. Hello, look at the market in the U.S. right now. Um, that Because what happens is stocks always price in a recession well before it happens. The stocks got clobbered last year, and now they're recovering because even if there is a recession, they've already fallen so much.
Interest rates. Do we need to go higher? Do we need to go lower? Do we need to keep them the same?
So interest rates, as you know, are the one of the only tools that central banks have to fight inflation and cool the economy. So last year in 2022, interest rates went from 0 to 5%, and it looks like they can continue to go a little bit higher. This is all, I mean, this is all the central banks know how to do, is raise interest rates, and they don't want to see inflation at 4% or higher. And the last number in Canada showed sticky inflation, strong employment. It doesn't show a cooling economy. It still shows a very strong economy. So, unfortunately, I do expect the Canadian central bank to keep on raising interest rates, until there's a meaningful drop of inflation well below the 4% range, or they start seeing some job losses, and that doesn't look like it's happening. So that's only going to compound these housing issues going forward. But that's the tools of central banks. So if we learned anything this year, stock markets don't necessarily care that much about where interest rates are. They care about how quickly they move. And moving from 0 to 5 was a giant shock. If they raise interest rates, it's not going to be that much more, maybe another 25 or 0.5%, but God only knows. Um, I mean, I would never want to be ahead of the Canadian Central Bank. There's so many things to worry about. You
Mhm.
got to worry about the consumer. You got to worry about the housing market. The banks are under stress right now. And every time you raise rates, money can flow out of banks into alternative products. Uh, so, but I'd rather spend more time, to be honest with you, trying to figure out if Amazon's going to make more money in the next 3 to 5 years than where interest rates are going to be, because I can guarantee you in 3 to 5 years, interest rates are not going to be where they are today. They're going to be higher or lower because something will change with the economy. So it's better time for an investor like us to focus on where our companies are going to be, what the earnings are going to look like, what the business is going to look like. Try and predict that instead of rates.
Someone like Nassim Taleb would suggest that macro is too complex and that it's almost not worth your time trying to figure out complex systems, and that it's very difficult. So better to spend your time bottom up analysis on stocks.
Well, I always think that our brains are very linear in the sense that we like to think in algebra formulas, A plus B equals C.
Mhm.
And so recession, higher interest rates must equal disaster.
Yeah.
But you never, but there's never just two variables in that economic formula. There's a billion.
Mhm.
And you don't know how. Maybe there's a government response. Maybe by raising interest rates, it leads to something else with these companies. So there's always opportunities and areas and things that are going to work in any environment. And it's your job as an investor to try and be in those right places and get out of the wrong places. Um, Investing is cyclical. Like there's no recession proof company. There's no recession resistant company. Maybe the dynamics of oil and gas are going to be terrific over the next 10 years, but that doesn't mean the prices are going to stay up and go up each and every year, as you see. So like the economy is doing quite well. North America, oil prices have fallen off dramatically. Like, how is that? Well, there's other dynamics. There's supply, there's demand, there's traders betting on, the commodity prices. It's impossible to figure out. I think you're absolutely right. It's way too complex. It's better to focus our little monkey brains on things that are easier to understand. That's why I always go back to patient quality investing. It's just an easier way for me to live.
As an investor, your job is to earn a rate of return for your clients. If you go to the beginning of the Berkshire Hathaway reports, he'll write his scorecard down compared to
Mhm,
the S&P 500, for instance.
mhm.
What's your benchmark? How do you measure your performance? Do you have a cost of capital, so to speak? And what do you compare yourself against?
It's another great question. And so we manage portfolios on a separate basis. So that means if you gave me your portfolio, Trevor, you may have stocks that you wanted to keep and you work with me, or you may have stocks that you don't want me to buy for you. You may come in at a different time. So our benchmark is really hard. In the last couple of years, we launched an internal pool, an equity pool, like a mutual fund, only for our clients. And we're thinking over the next few months that we will actually have a retail mutual fund product because we think we have some unique ideas for Canadian investors, for unique Canadian only investors as well as North American investors. But my benchmark is 50% uh, on our stocks, 50% in the S&P 500 in Canadian dollars, and 50% in the TSX in Canadian dollars. I feel that's an appropriate benchmark for what we're trying to achieve. Right now, we have more of our clients' money in US stocks, but not exclusively. And I treat every client different. So some come to us and say, I don't want more US stocks, or I already own Amazon somewhere else. Don't buy me Amazon. So it's all weird in the way that we report to clients. but I work with people. I don't work, and people don't want to lose money. All the biases are very true. Making money is expected. Losing money is painful, and
Mhm.
losing at $2 hurts a lot more than making $2. So I would rather give up some upside to
Mhm.
make our clients feel more comfortable. I'm not running a hedge fund. I'm not taking performance fees. I'm not on that. I don't have institutional investors. We have a different mindset, and hopefully we're creating a lot of value for our clients with our wealth of knowledge and experience with financial planning and how to structure portfolios and how to help your kids get started. Things that Wealth Simple and buying an ETF on the S&P 500 can't get. What hurts me, of course, is when people compare their returns to the benchmark that they think they should own.
Mhm.
The last 10 years, as we all know, it's been impossible for anybody to beat the NASDAQ and the S&P 500.
Very hard.
Impossible. No one has done it. So, if that's what you're looking for, just do it on your own. The only thing caveat I'll say is good luck holding that through tough times, right? So people hire financial advisors and portfolio managers because they are either intimidated by investing, or they can do it themselves, but they don't have the time or the interest, and they're busy people. And so I don't necessarily think that our clients are always looking to outperform a certain benchmark. So what they're really looking for is reduction of volatility because they don't want to live through it, and that they'll have enough wealth to provide for their retirement and to give money for their kids. So that's our goal. My goal isn't to beat a benchmark, but hopefully with this product that we'll be launching, obviously that will be the goal, and that's a certain product for that. But the good news is, our clients have really done a lot better than the TSX over a long period of time. Not last year, of course, not 2022, but over the long term they have, and that's what makes us feel good because as Canadian investors, I think a lot of people are intimidated by buying U.S. stocks, but that's been the right place to be.
Efficient market theory would suggest that the markets are efficient. There's no point investing in stocks. Prices are baked in, and you might as well just buy an index fund because everything's priced accurately. How long did it take you to figure out that was wrong, and how do you explain that to clients or yourself?
Well, I don't think many clients would know the efficient market hypothesis. That's a hard word to say, so we'll move on. But I think a lot of people just like I said, they're looking for absolute returns. But yes, the game of investing is really you have to find your advantage, right? Some
Mhm.
people are looking, they think they're great at trading. Some people think they're great with information that they can figure out things before others. And then some are, well, I'm a long-term investor and that's my advantage. Other people can't hold a stock through a downturn. That's when I hold, that's when I add, and I don't miss out on the long-term gains. So we know that the efficient market theory doesn't work at all. I mean, how can it? Although in the short term, sometimes the prices of stocks are very right.
Yeah.
And the market sometimes, I mean, you can't, you have buyers and sellers at the same time. I mean, there's people, it's clear sometimes people have an informational advantage in the short term, and you can't discount that. I mean,
Mhm.
the Canadian banks started to not work. The oil and gas stocks started not to work as people saw that there'd be troubles ahead for the banks or troubles ahead for oil and gas pricing, and those stocks started to underperform. But if you have a variant view where, okay, we're going to go into a recession or it's going to be a slowdown, but this bank is going to continue to buy back stock and get more deposits, and Canada is going to continue to grow with population and immigration, and the country's going to get wealthier, then you ignore that stuff. So I don't know if this answers your question at all, but that's how we think about investing here. Is I feel the only advantage that a long-term investor has is what's called time arbitrage, and that they can, like I said, sit on their tush It's not to say you just buy a stock and forget about it. And you know, maybe we'll get into a little bit about how we think about buying and selling, but um, that's really what the long-term investor should do. To me, if the business is growing, the fundamentals look like they're improving, or there's a temporary problem that you know is going to be solved, and you can still see good returns from that investment, you'd be an idiot to do anything but hold on.
You can write your CFA, get your MBA, read all day long, do all the analysis you want, build spreadsheets, run the numbers, sit behind a desk. But at the end of the day, if you don't have the psychology for investing, you'll sell at the wrong time, and or you won't buy when things are down. How important do you think psychology is to investing?
It's everything. It's everything. And as a professional investor who gets paid for this as a living, I mean, I go through all the same things as everybody else who doesn't get paid for it. It's living through a drawdown, Trevor, is impossible.
You can't
And
teach that.
you can't teach that. So we went through drawdowns on the big tech stocks last year. It was swear word painful. But we kept our eyes on the prize. They got overvalued. I mean, that's the bottom line. I mean, if I made a mistake in 2021, I made a mistake that I didn't recognize that interest rates were going to go from 0 to 5%, and these companies were overvalued, and that the COVID bump was going to slow down. Right? The work from home trend, the only ordering stuff online, everybody spending money to get their self automated. I mean, that trend was going to slow, and we didn't see that. But what we saw is, okay, but I still see the earnings from Microsoft and Apple and Google and Visa growing.
Mhm.
So, growth can get you out of a lot of mistakes over the long term.
Intellectual humility. You're willing to admit you're wrong or that you don't know. Do you find that rare in the investment industry with people trying to run an investment business?
Well, I mean, everybody's playing a different game. So, I mean, that's the thing, Trevor. Everybody has a different approach, and I'm no one to judge anybody's approach. I fool around sometimes on that on Twitter because I hate when people the S&P is going to 3,600. Shut up.
Yeah,
Like that's just so annoying. Like that's the game they're playing.
exactly.
And I can't fault them. And they have a family, they have a job to do, and that's how they make money. But it's humility is markets are humbling, and there's no perfect investor. Buffett gets his head handed to him all the time. He's
Mhm.
made some terrible investments. But if you have some great winners, that takes care of a lot of problems. But yeah, we're absolutely willing to admit we're wrong all the time. We tell our clients up front, we're buying a portfolio of 30 stocks. There's going to be a couple real stinkers in there, and we're going to screw up. And we did last year. We owned PayPal that got destroyed. That was just a terrible investment on our part. We got caught up in believing the management, and that was a mistake. And I feel really bad about that purchase for our clients. We the only silver lining is I sold it at a price that's much higher than it is today.
Mhm.
We also sat on our tush too long on Facebook on Meta, um, and then of course it went so much lower than where we sold it at, and now it's so much higher than what I sold it at. So I mean, it's like, what can you learn? So my colleague Ernest Wong, who's our head of research, he said something, it's very interesting, and I really take it to heart. I'm like, worrying about the worries that everybody else has is counterproductive, and I think that goes. I think that says a lot. Um, when everybody's worried about the exact same thing, the headline story, the front page news, the narrative of the day,
Mhm.
that's where the value and opportunity comes. But easier said than done, because we did sell Meta at a lot higher price than it fell to. I couldn't imagine us holding it I think we sold it close to 200. I couldn't imagine holding it down to the $80 range that it fell to. Like, so like I'm smiling that I sold it at that price, even though I should have sold it a lot higher. And now I look like a schmuck because I think it's 275 today.
Mhm.
So um, you have to be contrarian. You have to stick to your process. And these examples are good learning lessons for all investors and for me going forward as an investor, and my team is just, let's trust our research, let's trust our process, and admit when we're wrong and move on. Like there's no harm. You're gonna make mistakes. So many people will beat me up on Twitter for, one or two mistakes that we've made, but that's fair. Whatever, rub it in my face. I don't care. I've already pulled out all the hair, so it's all good.
That's life on Twitter too. You gotta take it with a bit of grain of salt.
Oh, totally, totally.
Well, today's June 6, 2023. To maybe leave the listener, what advice would you give to the general investor, the average investor out there in the current economic environment?
Well, some markets are difficult, as we've all learned, right? So I remember in March 2020, uh, bringing all my stuff home from the office, setting up my trading desk and office desk at my dining room table because there was no room in the rest of my house for me to work because, my kids were in the basement, my wife was upstairs, and, I didn't know what to expect. And I had no idea that, a few weeks later, or a few days later, that would be the bottom of the market, and then we would go on an unbelievable run. And then, of course, I didn't know at the end of 2021 that would be the end of this little market cycle, and that everything that could go wrong did go wrong. I didn't believe that Putin would invade Ukraine. I guess he amassed all those troops on the border, but like I thought it was an intimidation thing. I didn't think the supply chain issue would continue to cause inflation to skyrocket. Like they can't figure this stuff out. So what I would tell the regular investor, the retail investor, the institutional investor, whoever, I mean, you've got to find your style that works for you, and really let it play out, and learn from experience. Like if the last 4 or 5 years has taught us anything, it's that we don't know we don't know anything. We don't know anything, but what we do know is if you buy a good business, you pay a reasonable price for it, you be patient, you trust your research, I think you're going to have some very good performance. And that's all I'm trying to do, Trevor, is just try to own better companies, make better decisions. I remember some people saying, well, you should have been more nimble. But that's not our style. Actually, not being nimble is how we've created so much value for our clients over the long term. And so I really can't give advice to anybody because they have to do what works for them and their temperament. If this appeals to you, then then I've done my job spreading the knowledge about long-term investing. And learn from the greats, right? Read Howard Marks, read Warren Buffett. You got to read all his shareholder letters. I think you can download them all. I think there's a Kindle version for like $4. There's the Essays of Warren Buffett by Lawrence Cunningham, a great book. Read, and then if you want to learn about individual companies, learn from the greats. Mark Leonard at Constellation Software. Learn about Murray Edwards from Canadian Natural Resources. Mike Rose at Tourmaline Oil. Read their letters, watch their interviews, learn from those that really get what business is all about. Like the stock market is fun. It's just, prices going up and down. But what's a lot more fun is, owning great businesses and compounding wealth over the long term. So that's what I focus on.
Well, I think that's a great conversation on your investing style and a little bit about Baskin Wealth and everything else. People can find you on Twitter if they want to learn more.
Yeah, people can find us on Twitter. We also have a podcast as well, Trevor, not to compete with your amazing podcast, but the podcast called Long Term Investing with Baskin Wealth. And I generally do it with my colleague Ernest Wong or David Baskin. And we also, you can find us on BNN. You can go to my website at baskinwealth.com. We have lots of blogs. I love sharing knowledge. Send me an email if you want to, chat, and we'll go from there. So We're all learning. I think we're all in this together. There's no making fun of other investors. We're we're all here to learn and become better investors. So I view it as a common goal as for long-term investors who share the same vision. And I hope that's what your listeners are looking for.